Hey guys, welcome back to my channel. It's been a while since I uploaded a video here. The way I look at the charts has kind of evolved quite significantly over the past couple of years, and what I plan to do is post a couple of videos, like a mini series on different concepts that I use when I'm looking at the charts, and ultimately how I look at the charts, how I read them, and how I trade. So in this video I'm going to talk about market structure. Before I start though, if you're not familiar with what a candlestick is, what a pip is, what volume means, the really basic stuff, I'd highly recommend you go to a website like babypips.com and just go through their first couple of lessons just to kind of get a grip of the basics, because I'm not really going to cover too many basic things when I'm talking about stuff in these videos. It's mainly going to be kind of a bit more high level stuff, and it is fairly advanced. However, I'm going to try and explain it the best I can. So, market structure. When you look at a chart, it is pretty obvious that the markets move in one of three ways. They either go up, they go down, or they go sideways. So in the kind of market terminology and the trading terminology, an uptrend is when the price goes up or price is bullish. A downtrend, price is going down or price is bearish, and a range is where price is basically bouncing between two price points on a chart and going sideways. So to define these a bit further and a bit more in depth, there's a few crucial aspects to each one that you need to understand, and understand well. It is a basic concept, but it is something you really have to understand when you're looking at a chart, so that you can identify basically the phase that a market is currently in, if it's going up, if it's going down, or if it's going to the side. So you can just look at the chart and kind of take a guess. That's fine, but there are ways in which you can define it properly, and that's what I'm going to show you in this video. So we'll start with the uptrend. So as I've got here, an uptrend basically means the price is putting in higher highs and higher lows. So we look at this little crude drawing here. We can see that we've got a starting point down here. We push up, we make a high, make a pullback, and we put in a low. We then push up above this high to create a new higher high, pull back, make a higher low because it's higher than this low, and then again we push up to make another new higher high. So this would be confirmed as a uptrend. However, there is one crucial thing that we must understand when we're defining our uptrend. So we can see that obviously this is not price action, it's just a couple of lines, but for example's sake, we'll use this just now and we'll look at a chart in just a second, but we can see that the price comes up, we make this high here, we make a pullback, and we put in this low. Okay, now this low is not confirmed yet until this high is broken and closed above. So what do I mean by that? Well, we can see that the price pushes up in this example and closes up here. So this is higher than this high, which then means this higher low is confirmed as a higher low. And again, we see the same thing here. So if this, say this price leg here, if I can get this to, let me select it, there we go. So let's just say the price only came up to, like say here, didn't come up to this high, didn't close above this high. This would mean that this is not confirmed as the higher low just yet. And then from this point, we would then likely expect that price may then enter into a range, or it might even flip and become a downtrend, because we haven't confirmed this leg is actually bullish because we've not broken and closed above this high. So if that doesn't make any sense at the moment, don't worry, I will go into a bit further very soon. So we'll move on to the downtrend. Basically the same as an uptrend, just in reverse or flipped. So we have lower highs and lower lows. So we start here, we come down, we put in a lower low, we pull back, make a lower high. We've not confirmed this lower high just yet until this lower low is broken and closed below, which we see happens. We put in this lower low here, which then means that this lower high is confirmed, confirming that we're in a downtrend, and we obviously continue on like that. So again, if this is not making any sense, don't worry. When we come to look at a couple of charts, it will make perfect sense, I can assure you. And obviously the third condition the market can be in is a range. And as we've got here, it's a range is defined when price is moving between 2 points on a chart, 2 price points on a chart. You know, so it's just kind of bumping in between these 2 points here, moving sideways, so price is obviously clearly ranging. Okay, so let's have a look at an example on a chart. This is the chart of the pound US dollar. This is a forex currency pair. Everything that I'm going to talk about applies to all financial instruments, be it currencies, stocks, commodities, indices, whatever it is, the principles will apply to them. So let's have a look at the chart. We'll start up here. We'll see price comes down, puts in a low here. We have a pullback. We put in a lower high here. We'd then be waiting for this low to be broken and close below to confirm the downtrend, which is what happens. Price comes down, breaks and closes below this low, which would then be a market structure shift because the price looks like it's been going up prior to this. So we get this structure shift here because we've broken and closed below this low. We've put in a new low down here. We have a pullback, a small pullback, but a pullback nonetheless, and we now have a lower high. We'd then be waiting for this low to be broken and closed below to confirm that the downtrend is continuing, and that's what happens. We get this lower low here. We then get a pullback, putting in a lower high. Now, crucially, what we can see here is this lower high does not go above or close above this previous lower high. So that is important to know, because that confirms to us that, okay, we've not broken and closed above this low or this high, sorry, which means that the trend is intact. We're still in a bearish trend. We've not quite shifted into a bullish trend just yet. So at this point, we would be anticipating that either we're going to break and close below this low to confirm and continue the bearish trend, or we're going to see a break and close above this this high to shift the market structure and potentially be starting off a bullish trend to the upside. But that doesn't happen. We do see that price comes and closes down further below this low, confirming that the bearish downtrend is continuing. So we get down to this point here, putting in this low, and we've got this higher or lower high, sorry, back up here. So again, if this is all we could see, like this, we've put in this low here, we've got this high up here. We would then be waiting to see, okay, what's going to happen? Are we going to break and close above this high to confirm a market structure shift, or are we going to break and close below this low to continue the bearish trend? And obviously we see that price pushes up, breaks and closes way above this high, and even these two equal highs, relatively equal highs, closes above, puts in a new high. So at this point we've got a market structure shift because we've broken and closed above these two highs. So at this point we're expecting that price is probably going to shift and become bullish. So we get a pullback here. We put in a higher low. We then break and close above this high again, continuing the price action to the upside, confirming that we're now in a bullish trend. So we'd then be waiting for this high to be broken and closed above. Unless this low gets broken and closed below, then again we've shifted market structure again, and the trend has then become bearish. So we see the price does pull back and does actually close below this low, confirming that price is now back again bearish. However, if we kind of zoom out a little bit here, we can actually see that you could also frame this as a range, right? We've got these equal highs up here, and I suppose you could call this the bottom, or even this the bottom here, but we can see that price is actually kind of ranging within itself. although if we zoom in, we can then identify uptrends and downtrends. And that's the thing about these charts, they are fractal, and that means that the way they work, the way they move, the patterns that they print are the same on all time frames. So when you're looking at the daily chart, you might have each candle obviously represents a day, and you can see that price moves up, moves down. But when you zoom in and you look at the 4 hour, the hourly, the 15-minute, the 5-minute, whatever it might be, you see the same thing as the higher time frame, just you see more detail. And that's an important thing to understand, is that the markets are fractal, the charts are fractal. You will see the same things just with more detail the smaller time frame that you go to, and the more that you zoom out, you will obviously see less detail, but you'll be able to frame things in a different way as if you were to zoom in. So I mean, I can zoom in as much as I want and start to see micro trends, up and down, or I can zoom out and I can look at the 15-minute, the 30, the hourly, the 4 hourly, and this up leg here, that's a clear uptrend. We've got the high, we've got the pullback, the higher low, we've got the break and close above this high, confirming this was an uptrend. But if I go up to like the hourly chart, the 4 hourly chart, this would just be one candle, one single candle, So the market is fractal. We need to understand that, and this price leg here on a higher time frame may well just be a range, or look like a range, or as I say, look like just a single candle. So it's important to remember that the markets are fractal. So anyway, we'll come back to this. We can see price action again, moving to the side, not making any significant moves to the upside or the downside. We are, for all intents and purposes, ranging quite a lot here. We then see that price displaces and closes below the kind of low of that range, giving us a clue that, okay, price might be starting to move to the downside. We then see price pulls back up and closes above the high of this range. So at this point we're kind of undecided. Price is still pretty much within a range at the moment, and we've not really kind of seen any particular move or any move with any conviction to either way. But we did have this breakdown below, but then we've broken and closed above this high. So at this point we'd be looking at potentially price going up, but maybe if we're looking at the whole picture, zooming out a little bit, we can see that price, well, it was kind of ranging, but overall we have kind of came down from the highs up here. So looking at things on a larger time scale, you might be thinking that potentially price is going to come to the downside. So the other important thing to know, let's just have a look if we can find some bearish price action. And just to go back to the fractal thing as well, when we look at the price action on a higher time frame, so if I zoom out, we can see a lot more price action, and obviously the higher the time frame we go, the easier this is to see. But if I'm looking at kind of like this area, for instance, I can see on the higher time frame that, okay, price is moving up here, price is obviously moving up, and then when I zoom in and come to the 5-minute chart and I get more detail, I can then see the individual pullbacks, the push-ups, the pullbacks, the push-ups, and I can go from seeing what is an obvious overall uptrend on a higher time frame to then zooming in on the 5-minute, the 15-minute, whatever it might be, to then identifying the pullbacks, the highs, the lows, and that sort of stuff on the smaller time frame, if that makes sense. So it's good to have an idea of what's going on the higher time frame, higher time frame than the one that you're trading. It depends on if you're going to trade intraday, or if you want to trade over the matter of days, swing trading, or even position trading if you're trading for months on end. All depends on kind of what you're doing, but it is a good idea, no matter if you're wanting to trade the 1-minute chart or the hourly chart. It is a good idea to have a look at the larger chart, the larger time scale charts, like the daily, the 4 hour, sometimes even the weekly, just to get an overall idea as to where the price is kind of moving on those larger time frames. So let's just have a look at a downtrend here. So we see price comes down, we put in a lower low, we pull back, we put in a lower high. So at this point, we don't want to see price break and close above this high. If it does, then we're potentially shifting the market structure to go to the upside. Price doesn't do that though, it does come further down, closes below this low, confirming that we're in a downtrend. So we've got our high, low, higher low, lower high, sorry, down to a lower low. We then kind of range a little bit. We do put in a little bit of a pullback here. Doesn't close above any of this pullback, so it's kind of a range, and then price pushes again further down, putting in another lower low, pulls back, puts in a lower high, continues, puts in a lower low, and then we see that market structure shifts again here as we put in a nice big displacement up above this high, closing, confirming that the market structure has shifted or change of character, and that we could then potentially expect higher prices. Okay, so let's just briefly have a look at the daily chart here for the pound US dollar. So if I was to look at this is obviously right up to the current day's price action. So looking at this, we can see that obviously coming back from here, we've pushed up, we've put in a high, we've pulled back, we've put in a higher low, and then we've pushed up again, breaking above this high to put in a new high or a higher high, confirming that this leg here is in an uptrend. So this is on the daily chart, right? So each one of these candles represents 1 day's worth of price action. But the reason we look at the higher time frames like the daily, the 4 hour, the weekly, whatever it might be, is to get an idea and a bias of okay, where is the price action going? Where has it been going for the last X amount of time? So we can see that obviously we're in an uptrend here. We're in a bullish trend. What would we be expecting to happen from here? Well, potentially a pullback to somewhere around here. If it pulls back, closes below this low, we then know that okay, the price action has shifted to bearish, and we're now in a bearish trend. We're now in a downtrend. But looking at this at the moment, we can see that obviously we are in an uptrend. So we'd then come from the daily chart, would come down to whatever time frame it is that you're trading on, whichever one kind of suits you. And we know that okay, the daily chart was in an uptrend. So thinking back to what I was talking about, the ups, the higher highs, the lower lows, the higher highs and the higher lows, which define an uptrend. We know the daily chart is trending up, and the larger time frames tend to be a bit more reliable to follow trend-wise. So it's always a good idea to know what the higher time frames are doing to get the overall kind of longer-term sentiment of where the price is going. But we know the higher time frame is bullish. It's moving up. So when we come into the 5-minute chart, what we'd be looking for is the same thing: is price making higher highs and higher lows? And obviously it was, but we then broke and closed below this low here, potentially shifting the market to bearish. Now, what does this mean? Does it mean the daily chart's about to go down? Maybe. This potentially is the start of the pullback. So potentially price is now starting to pull back to put in a higher low, which obviously on the daily chart would take longer to play out than the 5-minute chart. But we start to see signs of that happening on the 5-minute chart before the daily chart, because again, the market is fractal. I know I've said that quite a lot, but it is something you have to understand. We see that price begins becoming bearish on the 5-minute chart by breaking and closing below this low here, which means that on the daily chart we're likely to see a pullback. Not to say the whole uptrend is going to shift to a downtrend, but what we might see on the daily chart is a pullback to put in a higher low, but on the 5-minute chart we obviously interpret that as a change of character, a change of market structure shift, or a market structure shift for price to then start putting in lower lows and lower highs as the price pulls back on the daily chart, if that makes sense. Let me try and just draw something to see if we can make a bit more sense. Okay, so just going back to the fractal thing for a moment, let's say the red lines here are the daily chart, or is the daily chart price action, and the yellow lines are the 5-minute chart, for example. So we can see on the daily chart we've made a higher low, we've pushed up, broken and closed above this high to put in a higher high. So we've confirmed that obviously this is an up leg or a bullish trend, an uptrend. Now we zoom in on the 5-minute chart and we would see something like, you know, a higher high, higher low, higher high, higher low, consecutively making higher highs and higher lows, confirming that this leg of the price action is to the upside. But what would happen then when the daily chart pulls back like this? So we're still in an uptrend overall, but the daily chart is coming back down to the downside, but it's not breaking below this low, so we're obviously still confirmed in an uptrend. But what would it look like on the 5-minute chart? Well, what we would see is a high, a low, a lower high, and then we'd break and close below this low to put in a lower low. So on the 5-minute chart, this down leg would actually become a bearish or a downtrend. Okay, so this pullback, whilst on the daily chart is in an uptrend, on the 5-minute chart, the entire chart becomes bearish, becomes into a downtrend, if that makes sense. You know, so we're breaking down and closing below the lows, and we're making lower highs as price pulls back on the daily chart, right? And then at some point, we're obviously going to see that we get a market structure shift. So price pushes back up, closes above this lower high to then put in a higher high. We then pull back again, put in a higher low, same thing again, break and close above this high to put in a higher high, and that would be represented on the daily chart obviously as the end of the pullback and the start of this next leg to push higher. So hopefully that makes sense. I know it is quite, it takes a bit of time to get your head around it, but the market's fractal, just understand that, and whatever's happening on the higher time frame, when you zoom in to the lower time frames, you're seeing the same thing. It's just you have to understand the fractal nature of the market, and the fact that just because the 5-minute chart has become bearish for this pullback leg doesn't mean the entire thing has become bearish or is now in a downtrend. You know, we need to see this bearish leg in the context of the upper higher time frame upper leg or bullish uptrend. So hopefully that makes sense. Okay, so the key things to remember about market structure are that the price moves in one of 3 ways. It ranges, it goes up, or it goes down. You should now be able to define what an uptrend is, higher highs, higher lows, remembering that when it's trending up, the higher lows are not taken out, they're not broken and closed below, because if they do get broken and closed below, likely the trend is shifting, the market structure is shifting, and potentially price is then going to start moving to the downside. You know, like here, up, higher low, higher high, or, well, equal high, breaks down below this higher low, market structure shift. And we know that in a downtrend we have lower lows, lower highs, and again the same principle applies, but in reverse or flipped. So we don't want to see in a lower, in a bearish trend, sorry, we don't want to see the lower highs being broken and closed above, because if that happens, potentially price is then beginning to flip again and switch to an uptrend. Just trying to find some bearish price action here. It's kind of rangy, but so yeah, here down, put in a lower low, pull back, lower high. We don't want to see this lower high getting breached, because if it does, then price action obviously is changing. Market structure has shifted, and we're making higher highs, higher lows, so we're then into an uptrend. And then the third the third way the market will move is in a range. So when price is kind of tightly squeezed together in an obvious box, or an obvious 2 points on the chart that the price is kind of just moving between, that's a range or consolidation. So as we can see here, the price within the box is kind of going from the upper side to the downside continuously and just moving really nowhere other than sideways. It's not really going up, it's not really going down, it's moving sideways. So that's a range or consolidation. So I do recommend that you have a look at some charts and just get used to reading the charts and identifying whether the chart is in an uptrend and a downtrend, or if it's ranging. Identify your higher highs, your higher lows, your lower highs, your lower lows, and making sure, like for an example, an uptrend, the lower highs are not being broken and closed below, because if that happens, that then obviously signifies market structure shift or a change of character, and that potentially the price is going to start moving to the downside. And again, obviously, on the flip side, for a downtrend, if the market's moving down, you don't want to see those lower highs being broken and closed above, because again, if that happens, potentially the price is going to move to the upside. Now there are a few other ways. Once you kind of learn to read the trend on just like a blank chart like this, there are a few things you can do to make it a little bit easier if you really want to. The first one, a lot of people use EMAs, or exponential moving averages, or simple moving averages as well, SMA. So here I've got the 50 in red and the 200 in blue, and these are basically used to help you identify the trend, right? So we can see that price action is below the 50 and below the 200, and the 50 EMA itself is below the 200 EMA, which would signify that the price is in a bear trend or moving downwards. And then we can see here the EMAs cross, and we can see price action above the 50, and the 50 is above the 200, which would signify an uptrend. But I still recommend that you get used to reading the higher highs, the higher lows, the lower lows and the lower highs, and especially the breaks and closes above or below those, because the EMAs are fine, and you can look back at the price action, and you can see that, wow, they seem to kind of work perfectly, but they're a lagging indicator, and that's the problem with basically 99% of the indicators, is they lag. They don't give you up-to-date information on the price, and they certainly don't give you, obviously, prediction on the price. All indicators do are indicate to you what's already on the screen, but just in a different way. So all these indicators are doing, all these EMAs are doing, is giving us the average price over a certain period of time. So this 50 period EMA is showing us what the average price is over 50 candles. And the same with the 200, that's showing us where the average price was over the last 200 candles on the 5-minute chart. So it's important to understand that, yeah, the EMAs are cool, indicators are cool, but they don't actually tell you anything else that you can't otherwise see by just looking at the chart. The one kind of thing that you can't see by looking at a chart really is volume. So there's a few different indicators you can use for volume, but you can't really see that by just looking at the candles. But everything else, like EMAs and stuff, you don't need them. You honestly don't need them, and it is better if you can read the price action yourself and understand fundamentally the price action and the movements yourself, rather than relying on an indicator to tell you what's going on. But that's the EMAs. You can use them if you need a little bit of a hand identifying the trend. The other way you can do it is use a fractal indicator. So what the fractal does is basically it'll print one of these little triangles above and below highs and lows. So this basically just makes it easier to see where the highs and the lows are in the price action. So we can see that this up leg here, we've got this down, we'll start down here, so we've got this low, we push up, we make a high, there's no fractal actually printed there, doesn't matter though, it is obviously a high. We pull back, we make this higher low, we can see the fractal printed there, we then push up, we make a higher high up here in the fractal. We pull back, we make this higher low here. We can see the fractal printed again. Again, push up, higher, it's actually a lower high. Then we kind of come down here. Now this is one problem with the fractals, is that this is printing this as a lower low. But for me, this is not a lower low because it's just a wick. It didn't close below this low, it just wicked below it. And again, this is a liquidity sweep. This is something that we'll talk about in a later video. So this is one kind of example as to why indicators are not 100% reliable, because I mean this is telling you this is a low. So from what I've told you previously in the video, this is closed below this low, right? So then you would be sitting waiting for price action to come down further. You would be thinking this is a market structure shift. Price action is likely to come down, but it doesn't. Why doesn't it? And it's simply because this is not, to me, a lower low. This is simply a liquidity sweep or a manipulation because we didn't close below this low. So that's one thing to be kind of careful with fractals, but you know, they do kind of make it a little bit easier to see where the highs and the lows may be, and it just makes it easier to kind of get used to reading the charts and the price action. So a couple of other ways that you can read market structure a little bit easier. You can use the line chart, so you can switch from candlesticks to the line chart. And this just kind of makes it a little bit easier to see where the highs and the lows are. So we can see starting from down here, we've got a low, we push up, we make this high, we pull back, we make this low, we kind of range for a little bit. This low doesn't come any lower than this low, so we're cool. We push up, we make a high, we pull back, we make a low, higher low, so we're confirming that this leg of price action is trending up. Conversely over here, we've got high, we make a low here, we pull back and we make a lower high. We're waiting for this low to be broken and close below, which happens. We make this lower low over here, confirming that this price action here is now in a downtrend. And we pull back, we make a higher low, a lower high, and then we continue on and close. But you know, the line chart can make it a little bit easier to read the price action and where the highs and where the lows are, so you can have a go at that. The other one is Heineken candles, if we can find them here. There we go. Okay, so what these kind of do is print candles which are more based on momentum rather than, you can see that some of them are different coloured to when I was in the candlestick mode, but these can be another way to kind of see where the highs and the lows are a bit easier. So again, starting here, there's a low, we got all these green candles, and we see there's a high here, and then when the candle switched to red, we can see that's a pullback, and we've got the low, and then we kind of range again, we've got that little liquidity sweep there, and we're waiting for either this low to be broken and closed below to confirm market structure shift, or this high to be broken and closed above to confirm we're continuing the uptrend, and that's obviously what happens. We break and close above here, confirming the uptrend is still intact. Okay, so that's the end of the first video, guys. Market structure. Like I say, it is a simple enough concept, but it is something that, you know, it can be a bit difficult to wrap your head around it, especially when you come and look at the charts and you're trying to apply this stuff. You can start to get a bit lost. So whilst it's a simple enough concept, it does take a little bit of time and practice to get used to it, and to really understand how to read the trend and how to identify the trend. I mean, it's not just about looking at the chart and saying, you know, okay, this is going up. Well, how do we know it's going up? How do we know that this is moving to the upside, other than the obvious fact that it has moved to the upside? But it's more about looking at the smaller details to find out, okay, yes, this price action is moving up, but is it likely to come back down to the downside? Is it likely to start moving down? because if we can identify that, if we can say that, okay, this price is going up, but when is it going to start moving back to the downside? If we can identify that, that's the first piece of the puzzle to making a successful trade, right? Because if we can say, yeah, it's moving up, but I mean, where do you buy? If you just jump in anywhere, how do you know that it's not just going to start moving back against you, or if it's going to start pulling back, or whatever? So being able to identify the trend is the first important part of being able to trade successfully. However, obviously it's not the only part. It is a part of the puzzle, and it's something that does take a bit of practice to get used to. But have a look at your charts, go through and identify when the price is moving to the upside, when it's putting in higher highs and higher lows, and it's not breaking the higher lows, because as soon as it starts to break and close below a higher low, market structure has shifted, and it's likely that the price is going to start moving to the downside. So have a look at your charts, have a look at identifying higher highs, higher lows, lower highs, lower lows, and also periods of consolidation or ranging markets as well, when the price is moving sideways, not really going anywhere. Just have a little go on TradingView or whatever charting package it is that you have. Alright guys, so that's it for this video. If you've got any questions or anything like that, you can leave a comment below, and I will see you in the next one. Cheers.